Welcome to Bank Debt for Business Growth. My name is Chris Sica. I am the Chief Revenue Officer for the Ronin Society. We're basically partners in growth for business owners. We bring institutional level financial planning and analysis and scalable management structures to businesses to help them grow through the 4 stages of small market business growth, which we think of as starting in the founder stage when it's really just a couple of operators, and then eventually they start to hire some additional help, and that takes them into the operator stage where they've got people helping them with their process, with customers, with their services, whatever they do. Eventually, though, they want to make that jump to the asset stage, which is where the business goes from being something that would just die if the founding team was involved were to leave, to becoming a true asset on their balance sheet where it actually creates value regardless of the owner's involvement. And then occasionally people that create asset stage businesses decide that they want to expand as well. And so they'll look at, outside funding to help them scale faster than their cash flows can allow. And so that's what we're here to talk about today, because generally if you decide you want to grow faster than your cash from operations will allow you to do, you've got to look at financing options. And that usually comes down to debt or equity. So equity is a very common thing. People talk about it all the time. People know about all the different options there. There's crowdfunding, there's notes, there's convertibles, there's straight equity. There's just an infinite number of resources at this point in Austin and across the country. But debt is often a really, really incredible tool that really doesn't get nearly as much attention or get as much resources devoted to explaining how that can be used for a business to grow. So that's what we're going to talk about today. And that's why we've decided to bring Keystone Bank here into this conversation to help us talk about what that can look like, what debt can be used for, how do you even start that process in deciding between debt and equity, and what are the pros and cons, and who's it really a good fit for. So I wanted to introduce the members of Keystone Bank that joined us today. So I'll go ahead and start with Tyler. Do you want to introduce yourself?
Sure. Hi, guys. I'm Tyler Marshall. I'm Senior Vice President, Deposit Operations and Strategy for Keystone Bank. So although a lot of today's discussion centers around lending, if we segue at any point in time, I'll be happy to answer any deposit related stuff. But I've been in banking 20 years. My background is in deposits, all things deposits, and the project management, product development, everything that surrounds that. So that's my side of the bank.
Thank you, Tyler. And we actually met Keystone through Tyler, primarily because we'd heard about the great work he had done around PPP loans and just getting those out to people and making sure a lot of smaller businesses that weren't getting the attention from bigger banks, got some help. And Tyler was instrumental in helping a number of people that we know do that. So thanks for all the hard work on that, Tyler. Kristin, you want to introduce yourself?
Yes. My name is Kristin Fisher. I'm the Vice President of Treasury Management here at Keystone Bank. My primary role is to help bring in businesses and help transition their accounts over from additional or other institutions and set them up with different solutions to help create efficiency with their processing of their financials with the banks. I've been in banking for about 10 years now, 2 years here at Keystone. So really excited to get to work with everybody here.
Great. Thank you for coming. This is awesome to have you. How about you, Dennis? Do you want to introduce yourself?
Absolutely. So thanks for this opportunity, guys. I mean, this is a nice forum and a great opportunity for all of us. So I've been in banking a little over 30 years. I've been with the big guys, JP Morgan Chase. I started my career at Texas Commerce Bank back in the day, but I love the community banking model. And so I reached out to Jeff Wilkinson, who founded Keystone Bank in late 2020, and said, hey, I want to be a part of your team. I want to help a small business grow. Just so you guys know, that's exactly what we are. We're just like you. We're a small business. We're in Austin, Texas. We're based in Austin, Texas. And we want to help all the small businesses here in Austin. And as you grow, if you get into other states, markets, whatever, then we want to grow with you. That's why we're here. So I'm the market president and my task truly is just to help with any process from deposits to loans. My background is commercial lending, but I do small business loans. I do car loans. We have a residential arm to do mortgages. So don't be surprised when you reach out to community banks nowadays. Let's just say that we compete with the big guys, the B of A, the Wells, and all that. But with our treasury management platform that Kristin will get into a little bit later, all our deposit services, we have mobile apps, all those things. So we're very small business friendly, and we just want to be another resource for you guys. And even if we don't get your business or earn your business day one, you'll still have cell phone numbers. You'll still have contacts here at the bank. We want to talk to you. We want to answer your questions, and we just want to be a good financial partner down the road. So I'm tickled to be part of this today, and have the opportunity to answer any of you guys' questions, and hopefully we develop relationships out of this.
Cool. Thank you, Dennis. This is great.
Yeah, you
And
got it.
Eduardo, do you want to share a little bit about what you do?
Well, I'm the newest member of the team. Yeah, I'm about, I think, 3 weeks into this thing, but I've got a 50-year background in banking, with 25 of that devoted just to SBA, exclusively to SBA. So I'm the Senior Vice President, Director of the SBA department here at Keystone. We're developing the processes to do SBA loans for just about anything you need, particularly the 3-4 aspects that you mentioned, Chris, whether it be startup, whether it be expansion, whether it be refinancing or restructure, all of that is available through SBA. So we'd be more than happy to answer any and all questions on SBA related for you.
Great. Yeah, SBA is a very underrepresented tool that I see in the small business market. The rates are great. The financing is totally doable, and I've seen a number of people acquire and scale businesses using SBA debt, and it's a pretty effective tool. So I'm glad we have you here today. Great. So we're going to kick this thing off. I figure everyone's probably got a lot of individual questions, and that's really what we want to focus on today, is answering your questions rather than just presenting a preset, deck or just slide or presentation. But to get this thing started, we did prepare a couple of questions so we could seed the discussion and get us off to a strong start. So I'm going to start with some really basic, easy meatball questions right across the plate. Let's start with a really basic thing. What are all the different types of debt, bank debt, that are available out there? Is there a really easy heuristic you can lay out of all the different ways that you can get money from a bank?
I guess I'll take the lead on that, Chris. Thanks for the softball.
Yep.
Maybe it's a softball for you, but for us, every deal's different, right? And so you can think of a conventional as just, a balloon, if you will. So we'll structure something, somebody's going to buy an asset, and we put it on a 5-year note with a 20-year amortization. But it depends on each deal. So there's TI loans for the small businesses in the retail space. They're going to have to deal with a landlord, and then we'll come in and help them finance the interior finish out. That is one of the riskier loans that we would do. Let's just say that, I guess, because that's all what we call TI, or soft collateral. And it runs the gamut all the way up to real estate. So real estate is probably the best and least risky in our portfolio, where somebody's actually buying a building or expanding their business, and we take a lien on the actual real estate. The advance rates are a little higher. We will advance on borrowing-based type transactions, where if somebody's truly just a cash flow type company, where they're converting inventory, AR, those things into cash, then we'll put advance rates on those particular assets and lend, 80 cents on AR, for example, or 50% on inventory. If it's all finished goods and it's just an inventory driven company, like we're getting a lot of requests today, because Austin's really growing with a lot of e-commerce. And so you're seeing some of these big companies that are just selling finished goods through the e-commerce sector. And we may go a little bit higher on the advance rates there, but every deal's different. We'll look at them all, and we're going to structure. That's the best thing about the community bank, I guess I would say, is that we're going to structure a structure that's going to make sense for everybody. Because what makes me sleep at night is not leveraging a company up, right? I mean, I want to go to bed at night knowing that we didn't over-lever a company. So we're going to be prudent in our underwriting. We're going to make sure that they have cash flow, they can service the debt, all those kind of good things. So maybe a long answer, but that's a really wide sort of A to Z what we can land on.
Okay. So one of the things that comes up a lot with business owners is this idea of a line of credit. They need to make a big purchase for inventory, or they decide that they want to hire either seasonal or new full-time help, and maybe the cash just isn't there. So could one of y'all talk a little bit about a line of credit and when that's best to be used, and what that generally looks like for a business owner?
All right, I'm going to answer, then I'm going to make Eduardo answer this as well, because there is a need for, and we've done this for, oh my gosh, a lot of companies here in Austin and around the state. But so lines of credits, people think that they can just draw them up, and what there's a word in front of the line of credit is revolving. And the key to a line of credit is that it needs to go up and down. So you're going to draw it up for a purpose, right? To buy something or whatever. And then hopefully the cash generated from the operations will pay the loan back down. We want to see that thing revolve, and we'll look at it every 12 months just to make sure that the company's, growing. Everything's working like it's supposed to do. Down the road, if it needs to grow and we need to increase the line because the business truly is growing, then we can look at doing that. But we keep lines of credit on very short maturity, typically 12 months or less. As the company grows and if everything's performing, then we can look at a 24 months. But we typically keep lines of credit really, really short term in nature, and you'll find that another thing that people may think about banks or commercial banks that say, we're not commercial mortgage guys, so we're not going to have the 30-year amortization type product. A lot of people call in and say, well, I want a 30-year mortgage, like a residential. So they're very used to the residential world, but they try to convert it into our world. And commercial banks are typically short-term lenders. And so we will keep our maturities 5 to 10 years. We do have products that will go to 15 years, but the amortization is really key on making those things work, right? And keep the cash flow coming so that it can service the debt. Where Eduardo and I, and I want him to answer this because the SBA is really good at it, and we've utilized this quite a bit. But when it comes to employees and those things that you're not funding an asset that's going to turn to cash, but it's what we call permanent working capital. That's the perfect use for the SBA program because they do fund permanent working capital, and it can be done in a line setting. So you would answer that?
Well, and there is a accommodation under the SBA program, but under a specific thing that they call the cap line program that provides a line of credit financing as well. We're doing it with a relatively new company right now where we want to instill that revolver function that Dennis was talking about. We want to educate them on setting up the borrowing base, doing the aging of the account receivables, doing the regular filing for that. And the SBA is the perfect tool to do that to help them do that, and then graduate them out later on in a year or two into a conventional structure rather than keeping them in the SBA. It's very important not to mix apples and oranges. The revolver is really more for that account receivable financing, that inventory financing. It is definitely not for tenant improvements or TIs like Dennis was referring to earlier. It is definitely not for equipment purchases, not for that type of stuff. It is really short-term driven because it is supposed to revolve. And when you need something else, then you come to the SBA because unlike the bank, like the regular bank, the conventional bank, we can offer long-term financing. If you're buying a piece of real estate, we can offer up to 25 years, and it's what we call fully amortizing. That is, there is no balloon. As long as the payment's made on time, you can have all 25 years to pay that loan in. So it's a very good, useful tool. And the same thing goes for equipment. We can go up to the useful life of that equipment, in some instances, 15 years. While the bank may not be able to do that conventionally because of our own cash flow, we can under the SBA. So the SBA gives us a great deal of flexibility to be able to offer longer term financing, which obviously improves the cash flow of the business.
Cool, great. So I guess the last question I'd like to ask before I open it up to the group is, what are some things that happen at, say, a business owner's timeline? What are some events that occur that cause them to say, oh, I should probably talk to a bank and start looking at debt? What are some of those triggers that people can be aware of or on the lookout for that say, oh, this might be a good situation for using debt as opposed to equity or just trying to ride it out, being cash poor for a long time?
So we've seen that. I'll answer one more time, and then Eduardo can answer from the SBA side as well. But we see that with landscapers. We see that with some of these e-commerce guys that are calling in as well. They're landing a bigger contract, right? So they have Neiman Marcus calling, or the landscaper guy has the University of Texas calling, and they have no cash to fund that particular request. And so we will look at that and we will help them. But we got to know the contract is legit, right? It can't just be a word of mouth or a LOI or different things like that. But we'll work with them on what we can say PO finance or job finance or any ways to kind of help them lever to win that additional business. That's the calls that we get. Let's just say that when they're tapped out, but they have a great opportunity in front of them. Call. It can't hurt. I mean, call You don't have to call us. You can call any banker, call your CPA, but just reach out to folks and figure out what do I have available to me so I don't lose this opportunity, right? Because it's all about seizing that opportunity and helping that business grow.
Great. So we kind of kicked this thing off with a couple questions that are a little bit more broad in scope. I'd like to open it up to the group and let some other folks chime in and ask questions about their specific situation or something they just have some curiosity about. So I'm going to open it up. Let's see. Tony, do you want to go first?
Sure. So I have a two-part question. Number one is, when you say community bank, does that mean you're limited to businesses that are in Austin, near Austin, close to Austin, in Texas? And then second part of the, or not second part, but a different question would be, can you talk a little bit about purchase order loans? Like if a small company comes in and says, look, I got this purchase order, Walmart's going to buy 100 million Zing Zats from me, but I got to go get money to make 100 million Zing Zats. So those would be my first two questions.
Well, I'll jump in and answer, Tony, that's a perfect opportunity for SBA on the second part, because the SBA has an accommodation for purchase order financing. Specific, you have that opportunity to for those 100 million dingbats, and we can help with the support of the cost to produce those products, and then wait until get paid by Walmart. So it's a very good little product that it is very underutilized, and we'd like to use it more. So give us the opportunity. You want to handle the market?
Well, and then I'll add to that too. So purchase order finance is probably one of the toughest things to get out of banks. So let me just say that we added Eduardo on the SBA team recently, and I am so tickled because you don't dabble in SBA. You got to hire the folks that are seasoned and understand that. And Eduardo's been around for a few days and very knowledgeable. He sits on the national board. And so we are tickled to have him on board so that he can help us grow and have these other options for you guys as small business folks. But that's the toughest one. Businesses need to be in place a little while. They need to have some existing cash flow. So we're not going to just help out a startup in that kind of a scenario, but we're going to talk to everybody. We're going to see what works and see if there's a structure that fits. On the first question, the first part of your question, so geographically, yes, we want to help. We're here in Austin. Our headquarters is in Austin. We want to help Austin grow, all small businesses here in Austin. Will we do deals in Dallas and Houston and El Paso? And yes, we'll do deals all across the state of Texas, especially now that we have Eduardo. He can do that in his portfolio, and we will love to look at any of those opportunities. We have franchises that come into Texas, and so we finance a lot of preschools, like Kids Are Kids and those kind of guys. So we'll look at those across the state. The reason why we'll go out of state, it would be existing relationships. So somebody that's here and they're expanding, or they're buying an asset in Colorado or a second home, or I'm doing one up in Wyoming right now, Whitefish, Montana. I mean, Montana, not Wyoming. But so we'll do that. But that's going to be with our existing customers who have a history with us, who have a good relationship with us, and just starting to look outside of our geographic areas. And we still want to help those guys too.
Great, thank you.
Awesome. So we got a couple more questions coming through on the chat. The first question is, does Keystone offer factoring?
The short answer is no.
Okay. And
there's factoring groups here in town, and if that's needed, we can, and I'm sure, Chris, you guys have options for them too, but there's a couple good ones in town. And let me just keep saying this though. So that's a good question, but maybe you're eligible for borrowing-based finance, which is very similar, right? And it costs a little less than factoring. So don't get discouraged and just ask questions. That's all it takes.
Can you talk about the difference between the two and why one is cheaper than the other?
Well, so it's typically seasoned businesses that are going to come to us, and our advance rates are going to be a little higher, possibly. But we'll draw the line up, right, and use the borrowing base to help them finance those receivables. And then when it's collected, then we want to pay the line down. So maybe their receivables are taking 60 to 90 days out, where in the case with factoring, they're going to get funding day one, and it may be limited. It's a range on the product type and the company's needs, I guess, at the end of the day on the pricing of that. But they typically limit their advance rates a little tighter, but you get your funds day one.
And then you keep mentioning borrowing base. I think I have an idea of what that is, but can you explain what that is? And is there a shorthand version for a business owner to figure that out?
a short version.
Is there like a way for a business owner to kind of like quickly come up with an estimate of what that might be for them?
Oh, sure. Just look at your balance sheet. Take your current balance sheet and just look at your AR. And it's all based on age, AR, right? So at the end of the day, what banks will typically do will look at AR that's 90 days or less and give you an advance rate on that. And so AR, some banks will do 85%, some will do 90, some will do 70. It just depends. I would increase my advance rate on AR only if that AR was insured. And those are typically bigger companies, but there's AR insurance out there for the companies to use and utilize. And again, that makes them, it's just mitigating risk like any insurance does, right? And so we would give them credit for that and give them a little higher advance rate if that's needed. On the inventory side, again, that's a little tougher, it's a little riskier. So we limit that to 50%. So you can look at your balance sheet, run those numbers, and that gives you an idea of what we would advance against that. So 80% of AR, 50% of inventory. That's your top of the borrowing base, which means that's the most that you can come to the bank and borrow at any time.
Great. And you said there was another option besides factoring. I didn't quite catch what that was called.
Not sure.
Okay. I thought you maybe mentioned one, but we'll move on. We'll move on to the next question. So the next question is CPG companies. So consumer packaged good companies, they don't self-manufacture. So the question is there a strategy that can allow them to get a loan for sales and marketing expenses? Because it seems like a lot of times it's difficult for businesses to get debt for a sales and marketing expense to help grow top line. Is that true? Is there a reason for that? What do we do about that?
Usually the reason that we find that is because we lump that into working capital. So what you're saying is that I need working capital to expand, to pay for those marketing expenses, to pay for an employee to travel. That's all working capital. And a lot of times what happens is that there's nothing to support that working capital. No, the repayment of that working capital, no historical financial cash flow, none of that stuff. That's a perfect use of the SBA program, because it's to do a pure working capital loan that's available under the SBA. And so it's something to look at when you're talking about that working capital component to use the SBA program.
R&D fits under that as well, just so you know. I mean, that's an expense that needs to be funded somehow, some way, right? But it doesn't necessarily lead to cash at the end of the day.
Okay. So if there's not something to kind of borrow against, it's difficult to justify that from a debt perspective.
Got outside independent net worth, it's an unsecured loan. So what do we depend as a repayment source for the bank?
Yeah, makes sense. Looks like we had a question from Alexander Lutt.
Hey guys, Alex here. First off, shout out to the Ronin folks for putting this together. Really enjoyed the conversation so far, and thank you to the Keystone folks for you guys joining as well. Colin was listening actually on behalf of my wife. She has her own marketing communications firm based out of Austin, woman-owned business, 2 million plus in revenue. Was calling because I think that you all started touching on some of the terms that I wanted to bring up in terms of recourse, personal guarantees, but inherent to the nature of their business. So they're a consulting firm, short-term contracts. They're not going to have a ton of AR. They're not going to have fixed assets. You started touching on the working capital loans. They would really like to explore the debt markets to continue to expand the business and the team, but without those traditional hard assets against which to lend and not really secured long-term contracts. What kind of options do they have? I'm not really familiar with any of the SBA 8A loans, or do you guys have any other products that you would recommend for them with a track record of revenue, but not necessarily anything against which to secure it?
I don't know how to put this, but there's definitely
Don't sugarcoat it.
No. It's more of where to start. As you had a lot of questions and they're all into one.
Yeah, and I don't mean to hog other people's time. If it's better to someone.
No, that's right. A couple of points on your comment. One, when you comes down to small business financing, the owners are always going to have to be personally liable on the debt. That's without question. Because you're talking about, usually the business being dependent on the success of one or two key people. And so we want those one or two key people to guarantee the debt, to remain the interest and hopefully pay us back. But yes, there is, everything that you're talking about is either contract financing or working capital financing. And it is not unusual for us to face a situation or find an opportunity to lend for working capital, because all businesses start out struggling, and they usually come to a point where they need a base level of working capital to always maintain. And if you finance it with short-term financing, like a line of credit, you're always going to wind up being in that need for working capital. While if you restructure it, you use a program like the SBA to establish that baseline of working capital, which you then pay back over a longer term rather than very short-term basis, then you maintain a lot, you can retain a lot more of your own capital to put back into the business and have it grow that way. And the difference is here, the working capital that the bank can finance it for you, they're typically going to get paid in the business cycle. That is a year, typically. And they're using the SBA, we can do 3, 4, 5, even as long as 7 years, depending on what the particular need of the customer is. So there's a tremendous opportunity there to build that working capital base to then be able to self-fund a lot of that growth as well. Did I answer your question, or did I dance around it?
No, you answered it, but you probably created more questions in a good sense, just a detailed answer. But I'll grab your contact information. We can connect offline further.
Please.
Yeah, I'll add one last thing to that too. But guys, it's just about the questions at the end of the day. So these are great questions. So just the deal is, the answer is always going to be no if you don't ask, right? So ask your banker, ask your CPA. I can't reiterate that enough. But because there's ways. I mean, that's soft collateral. Those are they're risky loans to the bank because we're taking the risk. And then when you say, well, I don't want to guarantee the debt either, well, that's just another red flag for us, because I mean, who's believing in the product, you or us? And so we want you to be on the hook. We want you to be excited about what you're doing. And then we're going to figure out a way to help you get there. So we'll look at other assets if we have to. I mean, it doesn't have to necessarily be tied to the business. Some guys sold companies, they have a ranch or whatever. I mean, everything's open to discussion, but you just got to ask the question first.
Awesome. Thank you so much,
Just
guys.
as long as it's secured against my wife's 50% and not my 50%, I'm good with it. You can take it.
You don't take children or ex-wives or any of that stuff.
If she heard me say that, she'd probably be the ex-wife.
That you're in the state of Texas, and in the state of Texas, it's community property.
Yep. So follow-up question, we did have a question, which is, are there any creative ways to avoid personal guarantees as leverage? I'll end it at that. I mean, that's just the question.
Not on the small business concern. Because again, they go back to the comment I made a minute ago, that the success of the business is typically small business. It's typically centered around one or two individuals. And we want those one or two individuals to stay interested, and how they stay interested is by signing on the bottom line.
Yeah, there's a couple of things like corporate finance, and I mean, we have big companies, right? We have $40 million revenue top line companies that the owners will guarantee the debt. They'll kiss the paper all day long, no questions asked. And so then we get the little $100,000 guy, and he doesn't want to be part of it again. You just ask yourself questions like, why? I can tell you in my 30 plus years, I've never called on a personal guarantee, and there's a lawyer on the line, I believe, as well. And so I don't even want to go into a courtroom and even try to fight that, because I don't even want to get there. I mean, we try to collateralize the loan, and then whatever else after that, if there's any deficiencies, we'll seek that. But we don't want your properties back, contrary to popular belief. Banks aren't interested in taking collateral back. We want you guys to succeed. We want you to grow, and we just want to help you do that. And like I said, I sleep better at night when we underwrite prudently to make sure that happens.
Great.
I think I could chime in on that really quick. In 9 years of practice, and I've been in the legal field since I was 19, in various, even in personal injury matters, I can't recall one instance where we went after somebody's personal assets, even with a guarantee.
Thank you.
Wow, that's really interesting. Thank you. Thank you, Matthew. So question for you guys, just as a general, I decide that I'm interested in debt. I don't really know how to reach out to the bank. There's a phone number and a website, how do I decide who the person is? What's the role? Who do you ask? And then obviously specifically for Keystone, but who is that person that you reach out to if you want to develop a relationship with a banker as a business owner?
Well, I'm going to be the first one to tell you is you should always develop your relationship with your banker before you need the financing. So pick up the phone. Like here, if you call Dennis, Dennis is going to be able to shepherd you through what your need is. He'll look at the full quiver of services that we have and pick and select the services that would be best to try and address your particular need. And I do the same thing. I'm the lead on the SBA side, but if I see something that will be better suited on the conventional side, I'm going to sit down with Dennis, with Greg, with any one of our other lenders and come up with a solution that best fits the customer need. Because, we can't put a square peg into a round hole. We've got to be able to match the services that will be best for the success of the small business. Because if that small business person is not successful, we're not successful. Because the only way we make money is by that interest on our loans. And if we can't put it on the street or we don't get it back, we have some problems. So you're gonna see us always chime in on that, trying to get the better solution to address the particular need for the customer.
Let me demystify one other thing, because there's a question that comes up a lot of times, I guess. So when you're coming to a bank and developing those relationships, it's not about us, just so you know, it's about you guys. So we should be good listeners. Your banker should be a good listener. I don't get paid to put a deal on the books for you guys. And so I have no interest in whether the deal gets done or not. Some banks incent people differently to do that, but in the community banking world, we don't. Our mission is to serve the small business client, listen and try to find the right solution to make it work at the end of the day. So contacts, you're going to have a lot of contacts at the bank. Jeff is very good, our chairman and CEO. He's very good at meeting all the clients. He's heavily involved. He's probably more so involved than I'd like him to be in our business, but it's really cool. I always told him, I said, when we get to be a $1 billion bank, I said, are you still going to answer my phone calls? And I was told, not by him, but by his prior employees, that yes, he'll still call you Saturday night if you want him to. So that's the kind of bank you're going to get with Keystone Bank. I've been around the block a while, and that's not normal. So I'm going to toot our horn a little bit, but you call us. If I don't have the capacity to help you, I have other lenders that can, but at the end of the day, we're all going to listen. We're all going to try to find a solution for you. And again, we just want to develop that relationship and have that opportunity to develop the relationship.
Well, and that's the community banking model. I want to kind of just chime in and say, it doesn't even have to be somebody in the lending area. Kristin and I, on a regular basis, make those connections. We know who does what and who has the capacity for what. And we get those meetings set up all the time and have meetings like this, with clients and prospects. But, if you're banking with a community bank, before I cold called a lending department at a bank, if you know somebody that works in the deposit area of the bank, particularly at a higher level, reach out to them as well, because they can get you to the right place.
And to drive that point home, all our business cards, you have not only our office number, you have our cell phone numbers, you have our email addresses. So one way or the other, you can reach out to us and reach us and ask the question. We'd love to answer them.
Cool. So let's go to Philip Oob next. He has his hand raised, and then we've got a question from Chad we'll hit next.
I'm guilty of using big banks, and I carry a lot of shame around with that. So that's
Philip.
I use big banks.
That's appropriate. That's appropriate.
But so that leads to my question, and hopefully it's not too off topic, but I've tried to use community banks in the past, and one of the downsides is I end up having to use this bank for that and that bank for this, and the app is outdated. And so like I tried to use Guarantee a while back because they funded my PPP loan, and their app was troublesome. I tried to open a credit card, and then their credit card was through some other portal. So I had to log into 2 different portals to even see the balances, and then to communicate the 2 banks was troublesome. So how has Keystone kind of modified some of that? And for a small business owner that does everything himself, I can't have everything all over the place. So is that, how can y'all answer that kind of question on how you're making that happen?
Yeah, I'll jump in on that one. Keystone has invested in technology. You know, we have invested in the best and are staying up to date and up front with all the newest available technologies out there, because we want to make sure that's the only way we can compete with those big banks. You know, we've got the full treasury management system. We've got a good basic personal online banking where you can do mobile deposits. We're connected with Zelle for personal use. With Treasury, you know, we've got your ACH platform that you can originate payments and debits. You can originate wires from there, international and domestic. We can get you set up with a check scanner in your office if we have any, you know, checks. We've got a great bill pay site as well. And then we also offer merchant processing. So Keystone has truly invested in the technology that we offer our clients so we can be at the top cutting edge of our industry within this area.
Yeah, the platforms that we use, and my background's in community banking. Actually, Dennis and Eduardo and I worked together at a different community bank for a decade before Keystone, but we're all in on the digital banking suite, and it's all connected. We work with the same core processor, and so we don't have things that are taped together and stuck together with popsicle sticks kind of thing. It's all integrated and all works together. And one of the things that we're working on right now is to work with fintech aggregators so that we can integrate seamlessly with a lot of these fintech solutions, these apps that are for accounting or for point of sale and you know, specific to different types of businesses. There's always a vendor at each, you know, kind of industry that kills it on a software product, and we want to be able to connect seamlessly with those and keep all that moving for you as well. So that's kind of one of our current projects.
Yeah, and with that project, you know, the need came up with because a couple clients needed that. They had the software, they wanted to connect with Direct Connect with that software. And with community banks, we can say, okay, we can take a look at it. The decision makers are right here, and we can get with the team and, you know, plan out what it would take to get involved and connected with those fintechs. So that's another benefit of community banks. We might not be connected right now, but talk to us and we are willing to keep your business and additional business, because that's the area that's growing, to make that connection and make everything work.
Well, that mostly answers my question. You mentioned the check scanner. I've never even seen one of those. Do y'all do the mobile deposits?
Yep, we do it all.
Okay, yeah, that'd be better than that.
Those are for the high volume, you know, I deposit checks a day kind of customer, where you just kind of stick a chunk in there and it zooms them through. And
yep.
So.
That sounds like a fun tool, Tyler.
Was that a good visual?
Yeah, I love that.
Yeah.
So
These are all
let's zoom
great
out a little bit.
All the chunk in there, I particularly like that illustration. Just chunk it in there.
Just chunk it in. So let's jump to a more broad topic that I would love to get a banker's perspective on. So how do you think about, let's say you are a business owner and you're trying to decide between taking on debt to grow versus staying constrained by, you know, your current cash flow. So you're a business owner and you're thinking, do I use debt to grow, or do I just stick with the cash that I'm generating and just try to make it work? Now, obviously, there might be some bias here in your responses, but that being said, how would you approach that? What would the mindset be of thinking through, okay, I do think this is a good time for debt versus I think this is a better time to continue to stick with just cash that I have? How do you approach that problem?
Dennis?
I love his broad question. He's like, I have a very simple. No, so again, it's all simple to me. That's actually kind of simple in the sense that, again, we don't want to over lever anybody. So we're going to take a deep dive into the financials with them, sit down with them. We got to know where they're growing and growing, so we can help them make a good business decision. I mean, because I truly believe. I mean, we've over our careers, there's probably been one instance where it was a retail type shop who came across that kind of crossroad and said, well, I need to take on debt to expand. And they found a way, actually, they utilized the cash and they, in their instance, they took on a family member, an investor, to help get the second store going, which is one of the riskier expansions is that second one. The third and fourth tend to get a little easier. And then that starts making a little more sense because then you can truly see the cash coming in. You can truly see the future of the business growing. And so I don't know, don't be surprised if you ask a banker and they're like, well, no, it may time to be bringing in additional equity. And no business owner wants to give up equity in their company, but sometimes you may have to do that versus taking on bank debt.
It's interesting that you said the second location is extremely risky. I've definitely intuited that, but I've never heard it laid out quite so starkly.
Ask your restaurateurs, it's any of the retail type platforms. I think they all agree. I mean, we're talking to a distiller and wanting to expand, and that's a big leap of faith going from what you're comfortable with because you spread your management thin. It's all those things that you're thinking of, right? I mean, that's just stuff to get you in trouble. How do I deliver the same quality, the same product, the same everything in multiple cases, right? And so those are hard, long discussions to have.
What are some other really difficult, I guess it's kind of like a Fermi paradox where you have to get through like a really difficult situation to get to the other side. So what are some other, like besides second location, what are some other really risky events that you see business owners go through? It's really interesting to get the banker's perspective on this just because you all look at it a little differently.
Growing too fast. Because I mean, not having sales can kill you. Growing too fast can kill you. So it's really developing a balance between what you can do and preparing for that next step. And that includes grooming the management for that next site, like we were talking about. Maybe taking on a different line of product. You've got to also have the expertise in that area. So I have a great deal of admiration for small business people, because I mean, I think the doctor was mentioning, everything that they have to do in order to get done. You wear at least 10 different hats at one time, and that's whether you do it during the day or do it at night. You've got to do it all, and it's especially when you start growing. There's so many different segments that could come back to bite you. I do want to go back to the mindset of taking on equity or staying in the current cash flow or taking on debt. Take into consideration the length of time that you're going to have before it starts generating, whatever step you're taking, starts generating enough cash. Because, us cold-hearted bankers, we have this little thing that we like to get repaid. It's a strange phenomenon that way, that, when we lend, we like to get repaid. Equity is something else altogether. That can be very patient and wait on the sideline while you're building up and then take the benefit of that growth. So it just depends on what you're looking at, what your horizon plans are as to whether or not you need to jump in and take that debt on, or stay within the confines of your own cash flow, or take on equity. And also get creative when you take on that equity. You guys at the Ronin Group, you will know that there's different ways to get repaid. You don't have to just take ownership. You can take a royalty on a product if you're doing that, or you can do some other subordination type product. So there's different ways of doing things. To just explore your options out there.
Yeah, I really appreciate you saying that. I think that's really what it comes down to is taking a look at all the options before you make a decision. And I think to touch on this a little bit, because we do answer these sorts of questions all the time at Ronin for our clients. And what we found is that there's really two parts to the numbers. There's accounting and then there's finance, right? And the accounting is what happened. And a lot of businesses have that. Some more clearly visible than others, depending on their accounting sophistication. But once you know what happened, there's a whole nother process of what you think is going to happen in the future, and that's finance, right? So, whether you want to take on debt or you want to take on equity or both, whether you want to match a long-term play with cash flow with long-term debt versus short-term with short-term, the whole asset liability matching principle, those all depend on having very clear books, really clear numbers, and any relationship, whether it's with a bank or with investors or really anyone, if you don't have really clear numbers and a clear idea of what drives those numbers, it's difficult to have these conversations or ask these questions at all.
You're hitting on that last little thing too. So I look at it as projections. So you can call it finance projections, whatever you want, but be honest with yourself first and foremost. And when you approach banks or your CPA, be realistic. Man, we see some deals, 2-year-old companies that are coming in and they're going to grow by 200% next year. And I'm like, really? How? When? But be honest. And some of them, hey, it may be that you can't do that. But let's just be realistic and do your homework, know how you're going to do that, and give us good factual information, because that's just critical on any kind of projected type financing that we're going to look at or the company's going to look at. And again, that comes to that over-levering thing. So if you give us weird projections and you're so sold on it that that's going to happen and we over-lever you, you can't hit your targets, then we're both in trouble.
Yep.
It's
So
just deep discussion.
yeah, no. So it's that's the stuff we love to talk about. So we've got 5 minutes left. Want to be respectful of time. Are there any other burning desires, any other questions people have that they want to get answered before we wrap for today? Going once, going twice.
I don't have any questions, but I just want to say I appreciate you guys putting this together, and for everyone from Keystone being on the call to answer questions and inform us. Thank you.
Thank you.
We appreciate it.
Yeah, thank you everybody for coming today. Oh, we got one from Jonathan. What do you got, man?
Sorry. Sorry, I did the hand raising thing. I want to say thanks also for the webinar. Thanks to Ronin. We've been working with Ronin. I'm here similar to Alex, attending on behalf of my wife, who owns a design company, female run business, just crossed $1 million in revenue. She's growing maybe too fast. So got a little bit nervous about that. But one of the things that we're looking at is we just bought a plot of land where hopefully it's the future site of her team's office. And wondering if Keystone does construction lending for businesses. And then also I was curious if Keystone also does personal banking. We are guilty also of running with large banks, and we saw the fallout of that when the pandemic hit. So we're looking to make a shift. So this is kind of timely, but just curious where y'all are at on construction for business.
The answer is
you go
yes.
first, and then I'll answer. Both are yes, but y'all go first, and I'll.
Yeah.
Hey, and I'm gonna say one thing real fast before they say yes twice or 3 times. This isn't about bashing the big banks today, guys. I came from the big bank world. Like I said, I was with JP Morgan Chase. There's good banks, there's bad banks. Everybody delivers stuff differently. There's a good reason to use the big banks, right? And that's not what this is about. But if you want a good relationship, want a good banker, there's probably some there as well. But community banks are notorious for that, and that's what we're here for. We're here to help all you guys because we're one of you. So go ahead and take it away on the other.
What I was going to say about that is 512-577-3236.
Oh, Lord.
Give me a call. Yes, we do interim construction to permanent, all on one, all day long, and we are definitely personable, as you can tell.
We don't have any fun at Keystone.
Well, in terms of the personal bank, yes, one of my goals joining the bank a year ago and since is to kind of round out our offering to make sure that we can bank on the deposit side of the bank, personal, commercial, and from every aspect, including, HSA, IRA, anything you got. So, and then, the PPP lending process, one of my big pushes this year is to connect. That was an unprecedented opportunity for us to make connections with business owners on both their commercial and their personal stuff. And so my big push this year is to turn those, borrowers into customers of the bank. And that's been just kind of a huge opportunity for us. But yeah, any personal, commercial, all of it we can do. I'd be happy to talk about the deposit stuff if you want to reach out to me as well.
Yeah, thank you. I will. I wrote your email address down, so thank y'all.
You, Jonathan. Thanks for coming. All right, well, let's wrap for today. I want to be respectful of time. thanks again, Keystone Bank. One, for all the work y'all did for PPP stuff and really helping some folks get across the finish line there. And two, for just always being willing to answer questions, help, be a great resource. You guys really are community minded. It's really awesome to be connected with y'all. So thank you so much for doing that. Thank you to everyone for coming today and asking great questions. And we'll get contact information out to anybody that wants it. We put Tyler's email in the chat. We will probably send out the recording once we get it edited a little bit to everybody that attended. And yeah, looking forward to seeing everybody again at the next one. Everybody have a wonderful, wonderful rest of the day.
Thanks,
Thank you.
Ronan.
Thanks,
Appreciate
guys.
it.
Bye.
Thank you.